Hi there everyone and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, so let's start off at the XJO as we always do, and we can see here the upward rally that we were talking about last week has continued. So the market continues to grind higher, ever so closer to the 200-day moving average through here at 71.66. In fact, we almost touched that today before reversing and pulling back down again. Markets are heavily overbought here now. We're trading roughly, probably leaving a little bit more than 10% from the bottoms here now. So almost 11% at the highs today to the lows of what we found in June. So yeah, definitely a very overheated market, very overbought. So we suspect at some point, now we're back at the 200-day average, we'll see a little bit of a pullback. Typically through reporting seasons, we get a push up into reporting and a bit of a pullback coming into dividends. Now tomorrow is CBA's dividend, so that could mark the sort of high of the market for the short term. Not here to try and pick the top though, guys. We might grind a little bit more, but I dare say we're very close to the top and we're going to pull back soon. Now, if we get across to the S&P 500, we're going to see something fairly similar. All right, so we've also seen a very, very overbought market back near the 200-day average here. The big thing I'm looking at now is questioning whether this becomes the downtrend line. All right, so if we fail here and have a decent pullback, then we could still be in a bear market, but that's way too early to call. Bit of a sort of megaphone pattern playing out here. If it breaks above that in the coming months, I'd remain very bullish. If it fails here and falls right back down, though, falling through that 36 is still on the table, guys, right? You can't deny that. You've got interest rates flying up. There's plenty of headwinds for the market. For now, right, though, we're in recovery mode. Back near what I would dare say would be the short-term top. I'd be very surprised to see much more out of the US market than what we've seen. And if it is, it might be just a little false break and a pull back in. Typically, August, September's most years are negative months. And with a very overbought market, a pullback is likely to come around the corner. It's just about timing and picking the right level. But for me, technically, this is the level. A break higher from here it will be very surprising for me. But we are in a crazy market, so it definitely could happen, right? All right, so let's talk a little bit more about what's actually happening out there, guys. Okay, so reporting season obviously is number one at the moment. Okay, so what we're seeing is the US reporting season coming towards an end. We saw a pretty reasonable reporting season considering that they've had 2 quarters of negative GDP growth in the US. So I think that's what's really helped rally the market. And as we know, the market's up here as well because we saw a slightly lower CPI reading that's spurred on quite a bit of buying. But locally, our reporting season's probably not even halfway through yet. We're seeing definitely some mixture of results. Quite a few stocks have been lifting quite strongly on the back of the report. Most notably was BHP today. So strong report from BHP, and we saw most material stocks sideways or lower today, but BHP up a good 4 or 5%. Big strong dividend, so I suspect BHP will probably hold some strength into the div, and then come back off and meet the other miners after the dividend. But nonetheless, we've got about another week and a half of heavy reporting from BHP. But the big thing that I focus on really in our market is dividend time. So, it's very typical to see our market rally really strongly into the reporting season, which we've seen this year. Mid of June, we saw that rally through July, through the first half of August, and now usually CBA's dividend, which is one of the first to go X, one of the first big ones to go X in August, marks sort of the top of the market, and we see either a bit of sideways or a reasonable pullback into September. But nonetheless, I dare say, being so overbought, we'll see a pullback at some point August or September. For next year, my prediction at this point is a move back to about 68 or 68.50. All right. Okay, so CPI is still high, guys, regardless of the slightly lower reading. There's still very high CPI. And what does that actually mean? Well, it means that central banks will keep the pressure on until CPI comes back near their target range. We're talking 2 to 3% here, guys. Okay, where we're still seeing CPI up near 6%. For core headline CPI up in the high 8s. for the US. So what that says to me is that there's more rate hikes to come, right? So end of September, Fed meeting, and expect another 0.5% still just to keep the pressure on. Let's see what the rhetoric comes out like. I dare say the pressure's still there, and what we don't know is how bad economic data is going to get over the next 6 months, given that central banks all around the world, or especially in the Western nations, are lifting rates very quickly to bring this inflation back down. Now, to bring inflation back down, you've got to kill demand, and that means you're weakening the world economy. Okay, so I think this rally we've been seeing on the market at the moment is a little bit premature. Yes, there's some great cheap stocks for a long-term hold, but from a short-term perspective, there's still a lot of headwinds coming for the market. So just be cautious here, guys. I think we saw the worst of the selling, to be honest. Okay, it's hard to say. Don't know what the future economic data is going to look like. But at this point in time, if we do pull back, I don't think we're going to create a lower low than what we saw a couple of months ago, okay? But I do feel we deserve a bit of a pullback here. It's run too high. Things are still not that positive out there. US yield curve is inverting further each month. That says there's still going to be an entrenched recession here. And as long as central banks continue to lift rates, we're not going to come out of negative GDP for the US for a little while, right? So that's my opinion anyway. It's obviously a forecast. It's obviously just a view, okay? But there's more. As long as there's more rate hikes to come, I'm still a little bit negative on the market overall, guys. I think we'll give back quite a bit of these gains. So is it time to get short? Look, my answer is yes. I'm looking every day for a signal to get in. So I am leaning more towards bearish trades at the moment, looking for good entry signals on stocks. In fact, the last two recommendations we put out to clients were both bearish recommendations on stocks, and we're getting ready to go bearish the index as well. It's just a matter of when, guys. It's not about, should we go short? Yes, I think we're overbought. It's timing, okay? Just because I've got the view the market's overbought doesn't mean I'm going short the market yet, guys. It means I'm looking and waiting to time it right. And it could be days or weeks before we actually apply the trade. But the markets are heavily overdone, and we're just waiting for the right signals, okay? So look, is it time to get short? My opinion is soon, right? Definitely the things are aligning for it. It's just a matter of when. Okay, so it becomes a timing thing. There's plenty of data coming up that could spin the market more positive, more negative. Okay, it's definitely a data-packed week. We're going to see a FOMC, minutes. Okay, from the last meeting. People will dissect that and pull it apart, and market might go up or down. And there's plenty of other economic data coming from the US this week. So look, data's the key right now. We're through the earnings season for the US. Now it's just focusing on economic data. If things start showing that, the US is turning, the economy is turning, for a bit of a turn to the worst because of all these rate hikes and the rest, markets might get a bit spooked from that. Okay, because at the moment the message is very positive. Okay, so they're refusing to call this a recession because of the strong job numbers. So job numbers are going to be very important. Any sort of forward-looking economic data is going to be super important, because if it starts to look like the US is going to go for a hard landing, then the market could also go for a bit of a hard landing. Right, so that's what we're watching out for. We're not seeing it yet. Okay, but the data that we've been seeing so far isn't really including the higher interest rates. So we're yet to see the true effect of these rates going up, and that's going to come through this next quarter that we're in at the moment, okay? So let's see how that plays out. For now, guys, for me, get ready to go short. This market's way overdone, and then, play some short-term bearish trades, okay? See where the market wants to land, and then sort of look at what the view is at that point of time. The largest risk is coming for us towards the end of September from the Fed. We know the RBA's like to lift rates again the first Tuesday of September. All right, so that's where we're at, guys. Not much else to say from here. So I hope you enjoyed this week's video. If you did, please like and subscribe. Otherwise, I'll catch you all next week. Thanks, and bye for now.